Gold is doing something that makes no sense if you only look at the surface. The asset people run to when the world feels dangerous has been falling during a dangerous moment. To most viewers, that looks like weakness. To me, it looks like stress somewhere deeper in the machine. And if you miss that difference, you may misread the entire next chapter. If you like videos that pull apart the headline and show you the pressure hiding underneath it, stay close, because the part almost everyone skips is the part that changes the decision. What looks like a collapse can sometimes be a clearance sale caused by panic somewhere else. Most people think a falling gold price means one simple thing. They think confidence is returning, the dollar is winning, interest rates are too high, and the gold story is over. That explanation sounds neat. It sounds complete. It also leaves out the one force that matters most when markets stop behaving the way they are supposed to. Because gold does not only trade on belief, it also trades on need. And need is louder than belief when a country, a bank, or a fund suddenly needs dollars right now, not next month, not after the next policy meeting, right now, before another invoice lands, before another currency slide, before another political crisis turns into a national emergency. That is the hidden tension in this market. On one side, the long-term reasons to own gold are still sitting there like loaded springs. Debt is huge. Trust in paper promises is thinner than it used to be. More countries want reserves they can actually control. On the other side, a short-term cash squeeze is forcing some of the very same players who helped push gold higher to turn around and sell it. And that is why this moment is so easy to misunderstand. People see selling and assume conviction has changed, but sometimes selling has nothing to do with conviction. Sometimes it is not a change of mind, it is a fire alarm. If your currency is shaking, your import bill is exploding, and your access to hard dollars is tightening, you do not sell what you want to sell. You sell what you can sell. Think about a family with a house full of valuables. They may love that old watch, that ring, that stack of cash hidden in a drawer, but if the power bill doubles, rent is due, and the car breaks down in the same week, they are not making a philosophical statement when they pawn something. They are buying time. Markets do the same thing. Countries do the same thing. Central banks do the same thing. That is the story so many investors miss. They look at the chart and ask, why is gold weak? But the better question is, who is under pressure? Once you ask that, the whole scene changes. A drop in price stops looking like a vote against gold and starts looking like a sign that someone important is trapped. And the trap is easier to understand than it sounds. A shock hits the world. Often it starts with energy, war risk, shipping risk, or a sudden break in confidence. Oil rises, transport gets harder, insurance costs climb. Nations that import a lot of fuel suddenly need a lot more dollars to keep daily life running. But those countries do not print dollars. They have to get them from somewhere. That is where the squeeze begins. Their own currency weakens because everyone wants the safer currency at the same time. Local prices rise. Inflation gets uglier. People get nervous. Businesses rush to hedge. Politicians feel the heat. The central bank then faces a brutal menu. Let the currency fall further, burn through foreign reserves, borrow at painful terms, or sell liquid reserve assets that can quickly be turned into dollars. Gold is one of the few assets that can be moved, pledged, swapped, or sold fast enough to matter in a real emergency. That is why a gold sale during a crisis does not automatically mean gold has failed. In many cases, it means gold has done exactly what reserve assets are supposed to do. It has become the thing you can reach for when the room fills with smoke. Now, here is where the story becomes even more interesting. The public usually notices the last step first. They notice the sale. They notice the falling chart. They hear analysts say the market is losing momentum, but they do not study the chain reaction that led there. They do not study the energy invoices, the weakening currency, the reserve stress, the financing gap, the policy panic. By the time they notice, the real cause is already several steps behind the price. And that is why price alone can be such a bad teacher. Price tells you what happened. It does not always tell you why. A person watching from far away might see someone running out of a building and think they are fleeing because the building has become worthless. The truth may be simpler and more urgent. It may just be on fire. This matters because the gold market has a strange habit. It can get hit hardest at the exact moment the long-term case for it is becoming stronger. That sounds backward, but it happens when the short-term need for dollar liquidity crushes everything in its path. The dollar becomes the fire extinguisher, even for people who still believe the building design is broken. So when you hear that gold is down because yields are high or because the dollar is firm, do not stop there. That may describe the weather, but it does not explain the storm. The deeper force is often a scramble for immediate funding, and scrambles do not last forever. They are violent, they are emotional, they are finite. That single word matters more than most investors realize. Finite. A central bank can only sell what it holds. A country can only defend its currency for so long in one way before it has to change tactics. A panic can look endless when you're inside it, but pressure trades tend to burn bright and then burn out. The question is not whether that pressure is real. It is how long it can keep dominating the bigger trend. If this kind of hidden pressure map helps you see past the obvious, you already know what to do, because the most expensive mistakes in markets usually happen when people react to the chart before they understand the reason behind it. The calmest money is often made by the people who can tell the difference. Let's step back for a second because history gives this pattern away. Gold has gone through this kind of episode before, not in identical form, but in recognizable rhythm. First comes the shock, then comes the forced selling, then comes the public disappointment, then comes the false narrative that the story is broken. And only after that, when sellers are exhausted and fear has done its damage, does the next climb begin. That middle stage is where people get hurt emotionally, not just financially, emotionally, because it feels like betrayal. You bought the safe asset, and then the world got more unstable, and instead of rewarding you, the market punished you. That is the kind of moment that makes people quit good ideas at bad prices. Markets are brilliant at doing that. They do not just test your thesis. They test your nerves. They test your timeline. They test whether you believe the story when it was easy or whether you understand it when it becomes uncomfortable. And uncomfortable is exactly what this phase is supposed to feel like. Here is the deeper mechanism in plain English. Gold has two lives at the same time. One life is as long-term protection against bad policy, currency debasement, debt excess, and geopolitical fracture. The other life is as immediate collateral and reserve liquidity during stress. In calm periods, those two lives support each other. In panic periods, the second one can temporarily attack the first. That attack is what creates the reset, not the death of the trend, the reset. A reset is when the market forces out weak hands, late buyers, borrowed buyers, and anyone who believed the story but could not survive the path. It is the market's way of draining emotion from a move before deciding whether the bigger forces still matter. And sometimes they matter even more afterward. Now think about the world gold is sitting inside today. Governments are carrying debt loads that would have looked absurd a generation ago. Trust between major powers is thinner. Sanctions changed how countries think about reserve safety. Trade routes are more political. Energy has become strategic again. Even if you never buy a single ounce of gold in your life, you can see the logic of why institutions would want part of their reserves in something outside another country's promise. That point became impossible to ignore once large pools of reserves around the world looked less untouchable than people assumed. The lesson was simple and brutal. If another system can block your access, then those assets may be yours on paper, but not in practice. Gold does not solve every problem, but it solves that one better than most reserve assets. So, no, the strategic reason many nations hold gold has not vanished just because some of them are selling under stress. In a strange way, the stress is proving the opposite. Gold is being used because it is valuable, liquid, and trusted when trust becomes scarce. That is not a bearish signal about what gold is. That is proof of what gold is. But here is the part regular viewers need to hear clearly. Even if the long-term case stays alive, the short-term ride can still be ugly, very ugly. Forced selling does not ask whether you understand the macro picture. It does not care that the long-term bull case makes sense. It just hits the market with supply until the pressure source starts to ease. That means you should stop thinking about this as one clean, straight line. Think of it more like three weather systems colliding. The first is emergency demand for dollars. The second is public confusion caused by falling prices. The third, which often arrives late, is the return of long-term buyers once the emergency starts to cool. The whole drama lives in the timing between those three systems. The first stage is the squeeze. This is where we are closest to the pain. Something external tightens the system. Energy costs rise, shipping risk rises, financing costs rise, a vulnerable currency starts to wobble, officials get cornered, gold is sold, swapped, pledged, or mobilized because it is one of the few assets that can actually do the job fast. The second stage is the fog. This is when the market tells the wrong story with great confidence. Commentators say the move proves the old thesis is dead. Retail holders get tired, new buyers disappear, the chart starts teaching despair. People who wanted certainty suddenly decide the uncertainty means they were foolish all along. This phase is dangerous because the emotional pain feels like information. The third stage is the turn. This is not dramatic at first. It is usually quiet. The selling pressure stops accelerating. The panic catalyst loses heat. The currency under attack stops making fresh disasters every week. Energy normalizes enough to reduce the funding gap. The market does not fly instantly. It simply stops falling for the old reason. That subtle shift is bigger than it looks. And once that shift happens, the whole frame changes. The short-term sellers are weaker. The long-term case is still standing. The public is still discouraged. That combination can create some of the most powerful setups in any macro market because the fear from stage two lingers even after the reason for the fear has started fading. This is why the smartest question is not, is gold down? The smarter question is the source of forced selling still getting worse, or has it begun to level off? Those are not the same question. One is backward looking, the other is forward looking. One stares at price, the other studies pressure. So what pressure should people watch? Start with the currency of the country or countries under the most visible stress. If that currency keeps breaking lower, officials remain cornered. Next, watch energy. If oil stays elevated, importers keep feeling the squeeze. Then watch any sign that financing conditions are easing, shipping disruptions are calming, or emergency policy responses are slowing. The market turn usually begins there before it becomes obvious in the gold chart. And here is a twist that many people miss. A heavy seller today can become a heavy buyer later without changing its worldview at all. A country may dump reserves during a crisis, stabilize, rebuild confidence, and then return to accumulation later because the reason it wanted hard reserves never disappeared. It just lost the ability to wait out the storm. That reversal matters because it means today's supply can become tomorrow's demand. The same hands pressing the market lower can, months later, help pull it higher again. If you do not understand that cycle, you will keep mistaking emergency actions for permanent beliefs. And that mistake can cost a fortune. Maybe the easiest way to picture this is with a water tank. Imagine a town stores water for droughts. Then a fire breaks out and the town uses a huge amount of that water in a week. From far away, you might say, interesting, they must not value water anymore, but that is ridiculous. The reason they used it so aggressively is because they value it precisely when conditions are hardest. Gold under reserve stress works in a similar way. Use does not equal rejection. Liquidation does not always equal disbelief. Sometimes it means the reserve did its job under pressure, and the only real question is what happens when the pressure passes. If you want videos that focus on those turning points instead of just reacting after the turn is obvious, keep this channel in your orbit, because the moments that feel the worst on the chart often become the moments worth studying the hardest. By the time comfort returns, the easy part is usually gone. Now let's talk psychology, because price moves become dangerous when they meet human weakness. When gold falls after a frightening global event, it creates a mental short circuit. People say, if gold cannot rise now, when can it? That question sounds smart, but it hides an assumption that markets reward logic on our preferred timeline. They do not. In the short run, markets reward liquidity first. They reward survival first. They reward whoever can meet payments, roll debt, calm a currency, cover imports, or close a hole in the balance sheet. Safety in the abstract and cash in the moment are not always the same thing. In a squeeze, the market chooses the moment over the theory. That is why viewers need patience more than prediction. You do not have to know the exact day this phase ends. You do not have to call the perfect bottom. You do need to understand the structure well enough so that a painful move does not trick you into telling yourself the wrong story, because the wrong story is expensive. The wrong story says gold is falling because gold no longer matters. The better story says gold is falling because the system is under stress and some important players need immediate liquidity. Those two stories lead to completely different behavior. One produces surrender, the other produces attention. Now, I want to be careful here. This does not mean every drop is a buying gift and every sell-off should be cheered. That is lazy thinking. Real damage can happen in markets. Trends can break. Conditions can change. But if you want to judge whether this is a true breakdown or a violent reset, you have to compare the selling force with the structural demand behind the asset. And that structural demand still has weight. Nations still want reserve assets with no direct political leash attached. Investors still worry about debt deficits, currency dilution, and long-term purchasing power. Geopolitical trust has not magically healed. The world is not becoming simpler, cheaper, calmer, or less leveraged. That backdrop does not disappear because a few stressed sellers hit the market at once. In fact, one of the cruel jokes of macro investing is that the strongest long-term stories often come with the most uncomfortable corrections. Not because the story is fake, but because crowded conviction, leverage, and sudden liquidity needs can knock the market off balance for a while. If you only believe in a theme when it moves smoothly, you do not really believe in the theme. You believe in comfort. And comfort is exactly what this market is denying people right now. It is asking whether they understand the difference between temporary pressure and permanent change. It is asking whether they can sit with uncertainty without inventing a dramatic ending. It is asking whether they can notice that panic selling by stressed institutions may actually be the event that rebuilds value for the next phase. That is the part that could matter much more than people think. Because if this is a reset driven by stress rather than a collapse driven by vanishing demand, then the recovery does not require a brand new story. It only requires the short-term pressure to fade. And fading pressure is often a smaller hurdle than rebuilding a broken thesis from nothing. So what would the next chapter likely look like? Not a straight rocket, not a cartoon rebound, more likely a process. First, the emergency selling loses force. Then the market stops reacting as badly to bad news. Then stronger hands begin absorbing supply. Then confidence returns slowly, almost reluctantly. And only after that do people start calling the move obvious. That is how important turns usually happen, quietly at first, then suddenly in hindsight. The crowd often wants a bell to ring. Markets do not provide one. They offer clues, stabilizing currencies, softer energy pressure, less urgent official selling, a stronger response to the same news that used to push price lower. Those are the kinds of clues that matter. So if you are watching this market, Do not just stare at gold. Watch the stress around gold. Watch the countries that are under funding pressure. Watch the cost of the necessities they import. Watch whether policymakers are still reacting like people trying to stop a leak with their bare hands, or whether they are finally getting space to breathe. Because once breathing room returns, priorities can flip. What was sold to survive can later be rebuilt to protect against the next shock. What was turned into cash during panic can become the thing institutions want back once they remember why they held it in the first place. And that is where this whole story comes full circle. The most interesting move in gold may not be the fall everyone is talking about. It may be the setup the fall is creating. A market under forced selling can look broken right before it becomes under-owned. It can look weak right before the source of weakness runs out. It can look disappointing right before it becomes difficult to ignore again. And that is why I think this moment deserves more respect than panic. Not blind optimism, respect. Respect for the violence of liquidity stress. Respect for the damage it can do in the short run, but also respect for the possibility that what feels like rejection is really just the system raising cash with whatever it can reach. If that distinction lands with you, remember it the next time you see a safe asset selling off in a dangerous world. The first explanation is rarely the complete one. Sometimes the market is not telling you that safety has failed. Sometimes it is telling you that someone, somewhere, is desperate enough to sell safety to buy time. And if you can learn to spot that moment before the crowd changes its mind, you stop being a passenger in the story and start seeing the machinery that writes it. Because the biggest opportunities in markets are often born in periods that look the most confusing from a distance. So no, I do not think the important question is whether gold looks strong at the top or weak on the way down. The important question is whether the forces pushing it lower are temporary stress signals inside a world that still has every reason to want hard reserve assets. If the answer is yes, then the drop is not the final message. It is the setup before the next message. And the people who understand that early are usually not the loudest. They are just the least surprised when the market eventually stops punishing the asset everyone had already given up on. That is how resets work. They do not ask for your comfort, they ask for your clarity. So watch the pressure, not just the price. Watch the need for dollars, not just the headlines about gold. Watch when emergency selling slows, because that is the moment the market's tone can change before the crowd notices. And if this really is a stress-driven reset inside a bigger long-term story, then what feels like confusion today may be remembered later as the moment the next phase quietly began. In markets, the loud move gets the attention. The hidden cause makes the money, and the people who know the difference usually arrive before the applause.